Wake up, buyer payer people. It's a beautiful day. Go grab yourself another cup of joe and say hello to Jim and Michelle Rhoads on the Buy Here Pay Here Morning Show. Take it away, you two.
Everybody, good morning.
Hey, good morning. Let's get an audio check.
Yeah. So if you're listening, just in comments, would you just let us know the last time that we got together with y'all on Friday?
It went live.
We
Or
had
Wednesday.
to.
It was Wednesday.
It was Wednesday, but we had to re-record.
Wasn't it?
I don't remember. Last week.
Yeah.
We had to re-record because the audio was again the board, and we're still.
So we did re-record and we have not yet posted it. But I've had people reaching out and asking about it, which is
so
great.
yes,
People are interested in
please
the
let us
conversation.
know if you can.
We'll get that publicized today and get it shared. I'm
Yeah.
gonna email it to the people.
If
that
you
have
can
been
hear
asking for it.
us, just send
give
a
us
thumbs up.
Let us know the audio is good. And we'll
Okay, Wednesday we had a huge weekend.
yeah.
And one of the things that that was brought up by one of our participants, I'm getting hello, Shane Rhoads, Brent Newman, and Shane Rhoads, and you can hear us just fine. Excellent,
good.
thank
Nice.
you. We had this last weekend our first class in becoming White Hat Way certified.
Yep.
And
all-day course.
An all-day course. And so we, got to people that we have known either at a conference or just virtually. We invited in our homes. It was really fun because there was especially one of the dealers that was like, oh, I thought when you guys were talking about coffee time, that was like just prior to the morning show. But it's like, oh, no. Because we introduced them to our patio where we have coffee time. And now you've lost sound. George, can you still hear us? I'm hoping so.
We may have some soundboard issues.
Yeah.
I'm not sure if anybody's hearing us.
Okay. Can you hear us? And just let us know if it changes and you can hear us again. So this is if we need to just unplug everything and just go straight on our sound, then we will do that. So let us know.
Yeah, let's verify once more if I could get another sound update. Yes, no problem, George says.
Okay. So we're just going to continue forward. So great weekend.
Yeah.
Great people. You'll hear more. You'll see more.
Certified, take them through the course.
Coaches and vendors.
And a couple vendors.
Yep.
Yeah. And so we didn't have that many dealers because we had a few that canceled last minute. One citing
sick
tax
and-
refund season
Yeah.
and one citing sickness. So we missed out on a few of those attendees. But yeah, we got the curriculum recorded. That'll be big for the next time around. And we're looking to June for the next certification course. So yeah, that was a big deal.
So
And,
that was pretty cool.
Shall we get into our subject?
Yes. So
So
do you want to give some background about why the subject even came
yeah,
around?
of course. So I think and you can take that banner down if you like, but we can roll that periodically to remind folks that we're on a white hat conversation. So this kind of came around as a result of kind of playing through this whole white hat thing and the white hat thing. Really, and the biggest part of a white hat approach is going to be helping dealers be successful. And part of that is through helping their customers be successful.
Yeah.
So naturally, if we're thinking in terms of, what is going to make the difference in customer success? What can we do to strike a balance between our profitability and the success of the customer? And obviously, there's more than just profitability. Things like cash flow and all these things. But that's really was the premise of the question. And I posed the question, and I think I said it on one of our V8 meetings a while back, that I was going to be asking the folks in the reinsurance space, because I've kept feeling like there's something I'm missing about why we would put markup in a vehicle service contract in the buy here pay here.
And this is a white hat way topic because it's, the question and the whole, the main crux of the question is about customer success.
Right.
And so we were just trying to, or Jim asked the question, just try to understand the why
Yeah.
that we choose to do.
Yeah, and listen, I
these
think people only
different
heard
ways.
part of a conversation. Sometimes they might think, gee, Jim and Michelle, with White Hat Way, you seem like you're more interested in the success of the customer than the dealer. No, it's both. Don't misunderstand.
It is both.
It's both. We think
Yeah.
when the customer is successful, the dealer is successful. And so this is part of why we, in this case today is a question. Like I honestly did not know the answer. I kept thinking there's going to be some information, because let me put it on the screen, Michelle, and start to show what the question actually was for those people who didn't see it. I asked the question. Let me get over here where I can manage this thing differently. The question is there at the top. Understanding that financing an optional reinsured vehicle service contract to a buy here, pay here consumer means, one, extending the term, right, and or the payment. So let's just talk that part for just a minute.
Okay.
If we add to the financed amount, then we're either going to increase the payment amount to keep the term the same, or we're going to extend the term, or some combination, right?
Yeah.
That's going to be the outcome of adding something additional on the contract. Now, we know that it also means earning interest on the financed amount. So the more we finance from the price of a service contract, the more interest we would earn, right? We know those pieces. So, and then I said, besides additional markup in a competitive market. So I get that part, right? If we're really competitive and we're trying to advertise on price and we're trying to, not scare off customers based on that part, it makes sense to me that you would have a lower price to be competitive, and then you would work to upsell the customer on this service contract. Okay. So that all makes sense. But I asked folks to just put that part aside, because we understand that would be, a situation that people would have to deal with. So I asked them, would you be advising a dealer to set the price above the required remittance amount? So let's clarify that part. And by the way, I'm going to pause for just a minute, Michelle, to make sure. One of the things we talked about in this course over the weekend was with dealers. I said, I asked them after the course in our post course survey, did you hear Jim or Michelle say anything that you would not want your team to hear?
Was there
or
anything
to hear your
discussed
customer
that would not be
to hear?
okay?
Right.
Yeah.
Right. So that's part of the premise of what we're doing with our white hat training, is we're getting to a place where we can say, and part of the reason customer success equals dealer success is it allows us to speak to dealers in a way that the customer could hear it. If I were talking to a sales manager and customer at the same desk,
Absolutely.
how could I have that conversation?
And knowing that this conversation is part of a syndicated podcast.
This
So
thing
it's like
goes out on
anyone who
YouTube.
has
Anyone
Spotify, whatever,
anywhere
is like,
could
this
hear
is a
this.
conversation that it's like, let's be really transparent.
Yeah.
Transparency is a buzzword right now.
Right.
But let's be really transparent about the whys,
Yeah.
that, what these things look like.
And we just, by the way, I'll stop and say then that we picked examples. These are absolute example numbers. It's based on just general observation of the industry, but term of the service contract would vary. There's obviously third-party service contracts. We're focused mostly on a reinsured service contract.
And just so you'll know, is I was peppering Jim with questions. I married into buy here, pay here, and it's just like I really wanted to understand, because one person came up with you should do a warranty, and it's like, okay, we're not talking about that today, but I really wanted to understand the difference, the benefits of both, and so we're doing a vehicle service contract, and just like there were a lot of questions I was asking about, like taxes, about all the different things, and so that I felt like I could ask questions that dealers would appreciate.
Yeah, and I put together a table that will address some of those things, but I tried to stay laser focused on this idea of, we're not talking about warranty today. So let me just quickly clarify for those listening who aren't familiar. A used car dealer could offer a warranty, in which case the customer doesn't pay extra. It's included.
It's kind of baked in a little bit, but
so the dealer sets
it's
the
just
price on the
everybody
car,
gets one.
and
Boom.
it's included. Everybody gets one. 100% of the customers get one. So now the service contract is optional. The customer has to opt in, which is part of the reason I'm asking the question of, how could I make it more attractive? And so the last part of my question that I didn't read yet is, why add profit on this product if a dealer's main objective is to have the customer shoulder some of the responsibility for any associated covered repairs? Because that is what would happen in the case of a service contract. Customers paying it, there's going to be some coverage, right? And so we don't get into the minutia today about what's covered, what's not covered. That's not the purpose of the conversation. It's really about whichever coverage plan we offered the customer and they chose, the profit that we might choose to mark up the service contract and put some profit in there. I'm just trying to understand if there are some strategic reasons, like for the reinsurance companies, is there some reason to do that besides putting profit?
Yeah,
back in the company?
and George piped in, and this is just something to keep in mind, is that third-party VSCs can also be reinsured. So this is
been doing this a long time. Didn't really realize that. So I think mostly what we see is people with a reinsurance company that are doing their own. They're working through some agent, as George would.
Can you make that any bigger on your side?
Yeah, I could try.
Awesome, because we're full screen.
So
So those of you who are listening, again, please go to our YouTube channel, which is Jim and Michelle Rhoads at the Octane Group, and you'll be able to see the charts, but we're going to kind of talk you through them. So again, so that, and while you're there, you might as well like and subscribe.
You might as well.
Might as well.
So can you see that?
Yes, a little bit better, but I mean, it can go larger
So
if you want to.
Okay, let me try one step larger and see if that's any better. All right, so
Much better.
Just
Okay.
examples, just example numbers here. So I just said, okay, let's set a price on a 24-month contract, and I said our cost is $1,000 and our markup is $1,900. I made it $1,900.
So $900 in addition to
gross
the
profit.
1,000. Boom.
That's right.
Okay.
So it's marked up price is $1,900.
Okay.
So that just says, and again, our term is the same. In some cases, with some companies, I think they can remit the payment on a reinsured product, like a reinsured vehicle service contract. At least they can send in the payment to the reinsurance company monthly rather than having to pony it all up front. If they choose that, I think. So, depending on cash flow and funding. But that should be the same because the remittance is going to be based on the cost. So it should be the same on either side. And somebody speak up if there's something I'm missing there. And so on the gross profit side, there would be none if we sold it at cost, and there would be $900 if we marked it up, right, in this example. The financed amount, assuming the customer pays no additional down payment, which would be uncommon, then the amount financed in that first example would be $1,000, and the amount financed would be $1,900. So the customer's payment would be whatever is negotiated, right? So
Without the markup, yeah.
Well,
Or
both.
with both,
I mean,
yeah,
in
okay.
either scenario, you would negotiate the payment with the customer, and so we're back to the thing about I can increase the customer's payment a small amount. I can put it all at the end of the loan and increase
Not
my term.
increase it at all, but
It's
then you
it's a
increase the
balance.
length
It's
of the loan.
whatever I negotiate with the customer. But I think if we just to exaggerate it, if we said the idea was all of it goes at the end of the note, then I think that would amplify some of the things we're going to talk about here. Interest earnings. So interest earnings would be based on that $1,000 note. In the no markup situation, it'd be based on $1,900 note. So obviously, it'd be more interest income. Sales tax. Well, sales tax, is my understanding, would be that's a sale that occurs, and so I believe you'll have sales tax.
And
somebody speak up if
most
that's
dealers pay that up front.
correct. And almost
Yeah,
every state.
I think Texas is the only one that I'm aware of that they pay it based or as payments come in.
Sure.
So, okay.
So what do we got? 70% of 1,000 or 7% of 1,000 would be $70. So you're talking about almost double that if you do 1,900. Okay. So just you be aware that's one of the things that would happen is our sales tax would go up.
And
a little
this
bit.
was one of the questions I asked. I was like, what are tax implications? And Jim's like, this next part about the income tax.
Income
If
tax.
if it's no markup, there's
no
nothing
income tax,
that you
right.
don't experience any income tax on that.
Yeah, and granted, we don't need to get into the minutia about discounting to the related finance company. Yeah, you're going to have a discount over on that side, and so this is one of the things that also came up that I didn't get on the table is people were mentioning, and we'll go through the comments here. We can actually get inside the comments because I asked everybody to let us know if they didn't want their comments shared. But the other piece that came up was the idea of advance rates, like how this would affect.
Oh
Advance
yeah.
rates with a lender.
Yeah.
So, that's also problematic because at the same time that advance rates were coming up, the question was coming up about pro rata refunds. Because remember, this is an optional product and the customer can cancel at any time. So that most commonly occurs, as some of them affirmed, is it most commonly occurs in the case of a repo. Customer repos after 8 months, and obviously the balance of their service contract is not going to be paid. So that gets pro rata kind of refund into the deal. Now, we don't, again, details that we don't need to really
I have
drill
a question kind of on that.
Okay, go ahead.
Is an extra $1,000 enough to push you out of covenants with a lot of your
No, I
your
don't think that's
capital
the question
providers.
there. I
Okay.
think it's obviously
Because I mean, if you're baking it all into the price, does it? I mean, how much leeway is there usually with a capital
I
provider?
think we better leave that to each
Okay.
individual lender and
All
their
right.
particular covenants. But I think everything I've seen is that
Okay.
lenders would advance on the service contract balance. They
Okay.
understand the value of having it in there.
Gotcha.
So now, if I'm a 50% advance, then it's a difference between taking a 50% advance on $1,000 and taking a 50% advance on $1,900, of which some is profit. Does the
Okay.
lender want us to be profitable? Yes. Now it begs the question, though, customer acceptance. Would customer acceptance be slightly higher?
Or would it make any difference?
Would it make any difference? We don't know. We can't know
Yeah.
that for sure.
I think that there's a lot of assumptions out there
Yeah, of
about
course.
whether or not it would.
You would just want to have
yeah.
some real data.
Yeah.
But what we know is, they call that a penetration rate, which obviously a lot of factors in there, including how well does the sales team upsell the customer to the service contract, right?
Which kind of like weaves in that thing about difference between and doing a warranty, but because it is 100% penetration, but this is.
But let's stop here and let me be a dealer for a minute.
Okay.
And let me just sit with you, Michelle, as though you're my customer, and I'm going to talk to you and say, this car that you've got has a short-term warranty, as an example. It's what a lot of people recommend, especially when there's a reinsurance company. It's common for us. We have a 3-month warranty.
Okay.
But of course, you can see that this contract that you're on the car that you're buying today runs about 36 months. So let me ask you, we need to talk now about a vehicle service contract. We have a service contract option for you, and I want to make sure you're apprised of that. And let's just talk about what would be your expectation if in the 4th month you have a repair that comes up, because these are used cars, they're machines, they break, right? They do fail sometimes. And so when that happens, what would be your thoughts about your plan about repairs on that? Because we can talk about a service contract and I can finance that in. And we can talk about, it could be a slight bump to your payment. We can look at that. I mean, how we finance it, we can be kind of creative about how we do that. But would you be interested in a service contract with, for example, a $150 deductible, which means if you had an expensive transmission or engine-related repair, and your part was only going to be $150 and you had protection on the rest, is that something you'd be interested in?
Yeah.
Right? And so that's how I present it. And now for me, it's really just a question of how, because as a dealer, I'm in the tote-to-note business anyway. I'm already in the business of financing and structuring notes. And so how creative I get to get the customer to agree to accept the service contract is really up to my techniques, right, and my own presentation of the thing, and then how creative I can get on the financial structure. But I can take, in both examples, I could not increase the customer's payment at all and just put it all at the end of the note. Okay. That's one option. Software will certainly accommodate that. Now, the next question would be, how's that different if I do that on 1,000 versus 1,900? Obviously, I'm extending the note farther when I do that, and it begs the question about the collectability part, which I have listed last. Is we don't know the collectability on 1,000. If I do it just strictly at cost, I don't know how much the customer's going to pay, when they're going to cancel. I don't know how much of the 1,000, even my risk, my cost, I'm going to collect. Now, that's back to the remittance of monthly. If I'm remitting monthly, then I've really only remitted that amount, and then the whole thing gets washed out and adjusted if the thing gets canceled. But if I'm, putting it up front or whatever, however much I've remitted, how much will I collect? Remember Brent Carmichael appeared on our podcast once upon a time, and he shared with us that in their studies, and we don't have the data on their studies, I don't know how many were in the pool, but fairly large study with multiple 20 groups, their numbers came back to saying that only about 15% of the customers were making it all the way to the final payment. Okay, so if we just
they either were repoed or traded. Could
have been traded.
Okay.
Yeah, as far as the
So one
ones
of the
who
two.
actually paid, and they studied in a way that they actually looked at the amount of the final payment to make sure the customer actually was making payments, and so that said that about 15% of the customers made it all the way and made a final payment. Now that's only one piece of information. There would be other things to look at, but it really, in any of these kind of things with buy here, pay here, it begs the question: with the profit that we put on the contract, how much will we collect?
Yeah.
And what is our motivation here? So when I put that at extra $900 of gross profit in this deal, it makes me look more profitable on paper, but it's just that. It's phantom profit. It's future potential collected profit, right? And I can draw against it. I can draw against that $900. You know, if I have a 50% credit line and my lender advances, I can draw, you know, some cash against that profit.
Yeah.
The question becomes, will I collect that profit? And if not, what's going to be the outcome for me? And I'm really just asking the question in the context of White Hat Way. And if I'm thinking about the success of the customer, and my particular motivation as a coach and as a former dealer is I want to see the customer accept financial responsibility for at least a portion of the repairs.
Yeah, and we had quite a conversation about that this morning too. It's like, so there's multiple things here about doing, you know, whether it be a warranty, whether it be a VSC, that there is a financial responsibility for the consumer. Now, 15% don't make it to the end of the note. It's a much higher percentage.
15% do make
Or
it.
15% make it to the end of the note. It's a much higher percentage that have problems with their cars that a vehicle service contract or a warranty would cover.
And so, and we can get to some of the comments here. We may run a little long today, folks, but I think the comments, I want to make sure and give folks credit for the things that they contributed to that thread. And if you're not a member of the BHPH Success Group, that's the only place I put this thread. So I did on most of my social media posts, I put a place where you can go and apply to be a member of that private group. And there are about 6,000 members in that group these days, so it's still growing.
It's grown quite a bit.
But it's a place where we have these kind of conversations. But again, this one we're taking kind of outside, you know, to really answer the things that are specific to, and for us, it's a white hat context. It's like, and again, these are just example numbers. But my question really is one of, you know, if my main motivation, and that was what my question in the social media post was, if my main motivation is just to have the customer shoulder some of the cost of the repairs, then I was just asking, and really I didn't know the answer, like, are there some things I'm missing about why? Because in my understanding, let me just be a dealer for a minute. If I got a reinsurance provider comes to me and says on a 24-month contract, we would advise you remit $1,000. My assumption in that number is that that should more than cover any anticipated claims against that kind of product. Okay, so I'm anticipating that the claims that, you know, will be my financial responsibility will be within that number.
Yeah.
So now the additional is really just profit to me, which I understand that the 1,000 in this example is going into the reinsurance company. We remit that and it goes over to this other company. The 900 in this example stays inside the finance entity, the dealership and the finance arm, as does the interest income that we collect.
Yeah.
So it's profit to us. The question that we can't know, and that's why today is really just a start. I call this part one. This is an ongoing conversation. The thing that we can't know today is what is, and look, I hope we can pull together people who have actual data that can be confirmed, and we're happy to you know, bring that to our listeners. But I think what we're trying to really analyze here today is, are we, because everybody knows, we say this thing all the time, you hear others dealers say it in the social media threads, none of us want to set up our customer to fail, because we could be hurting ourselves in the process, you know, not just having a customer fail and end up in repo, but we could be hurting ourselves in the process. Why? Because we paid sales tax and potentially paid some income tax on money that we didn't collect. Right?
And that was actually a question I asked this morning. It's like, do we have data on if you do have a vehicle service contract, how much more successful than just the general pool that those customers are in reaching the point where they can trade it in or they've paid the vehicle, you know, they've completed the contract. Because I think that's a pretty powerful thing if we can quantify that. I mean, we're in buy here, pay here. Everyone has an opinion. And, you know, and some of them are just like, just a gut or whatever. But I mean, some really hard, solid data about the percentages of people that are successful to make it to that point, or those that versus those that don't have a vehicle service contract, and being able to get to that point too.
And we've challenged folks in the past, and we're trying to live by that same standard. We're trying not to talk about numbers that aren't specific, because we just want people to, you know, we want to move past opinion, and that means getting some real data. And so one of the things White Hat Way is doing is going to work and collecting data and trying to help, you know, people make better, more informed decisions. And it's better done when it's not, doesn't have a sales angle behind it, right?
Yes.
I'm not trying to sell you something through my dad.
Yeah.
So this is
The
from Taylor
synopsis
Bird.
of Taylor. Yeah.
Newly married.
Yeah. Congratulations, Taylor.
Congratulations,
Yeah.
Taylor Bird, if and when you're listening. So I saw that he got married in
Hawaii. Yeah.
Congratulations again. So
We digress.
He said, marking up the service contract is really about maximizing profit, both margin and interest, which we've covered, right?
Yes.
So, but it's back to the thing about increasing profit. And then he asked the question, why sell something at cost if you could mark it up $1,000? And I'm trying to answer that question here, Taylor. And I don't
why?
have the answer, but I'm saying, why sell something at cost? And my reason is I have other sources of income and profit. I could choose not to mark up this service contract. And as a result, my payment could be less, my note could be shorter. I'm trying to get to the bottom of whether or not it benefits me or potentially hurts me to have that extra markup in there. I don't know the answer today.
Yeah.
Right?
Yeah. And does it necessarily benefit the customer?
Right.
Either way. I mean, is it success for them as well?
You could say it pretty clearly disadvantages the customer if they have to pay $1,000 more for it. If they're one of those customers goes all the way to the end, they pay $900 more.
Or if you want to try a dealer is marking up $1,000, but still trying to fit it in with a 36-month contract.
Yeah. There's all these things to consider. So anyway, Taylor, that's what I'm really trying to answer here is why would we not mark it up? And Brett Buick, most folks know him, especially in the Success Group. Brett is a rep with Buckeye Dealership Consulting, and they are certainly a prominent provider for reinsurance products in the space. And he gave good information. He touched on cash flow, advance rate, and average term are all things that would play a factor, and I agree. He also said, ultimately, whether you're selling a service contract or reserving for a warranty or both, in buy here, pay here, the principal loan amount is the same. And I'm not sure I understand that part. My thinking would be that if I sell a service contract.
And you're wrapping it in the loan.
Because if I have a 24-month warranty or a 24-month service contract, I'm thinking that my remittance would be the same. But if I mark up the service contract, then the principal loan amount to the customer would be different.
Yeah.
So
you might not have understood the.
So this is a future question. This is something we can dig into later because it's really a question of if that same dealer is providing a warranty, and that warranty for 24 months is going to take a reinsurance remittance of $1,000, then the same question is how much is the dealer adjusting the price of the car to accommodate the warranty. So you could add 1,000 or you could add 1,900 as a rough example. I don't think it works exactly that way in a warranty situation, but this is something to really kind of dig into for later. And then, so how profitable you are. So this makes sense to me.
Being profitable.
If you're suffering on profitability, then certainly you would want to look at marking up your service contract as a way to put some extra, we'll call it back end profit, right? In the deal, so that makes sense. And then Brent Newman, who has returned to and Brent we know has a wealth of experience in the business.
From being a dealer, and
I forget if he's JD Bywright or what his background was there, but then he also was a purchaser of bulk notes when we really got to spend some time with Brent. He was working with a bulk buyer, and so they bought a lot of notes, and obviously service contracts would have been a part of those notes, so these kind of conversations would have come up with them for sure. And he said, competitive market conditions, which is obviously something I was saying, I want to put that aside. In other words, if we're competitive and we need to reduce our price, I think we recognize that.
And he also mentions advance rates and, some of the comments that were before that. So it's like you're just kind of highlighting what's new information that it's like just something to bring into this conversation.
So I read through all these and I kind of focused on the ones that were kind of relevant to this particular subject, because some of them talked about the warranty versus VSC, and that's fine and interesting for the people reading the thread, but that's not our subject here today. So then,
what is the breaking point?
What are their breaking points? Which is really the thing that I'm touching on is if I'm bumping up against their PTI already, right? And now I'm So you can make the case, okay, I'm at 25% PTI, but if they don't buy a service contract, are they going to be able to afford repairs, which will be, money out of their pocket above the car payment?
Yeah.
So there's a line
So many
that we walk
factors.
here, and we have to figure out. But I think he's right to point out the breaking point, because that's definitely part of what we're bumping up against. And then this last sentence: this is true if the customer continues to pay that results in income versus a high markup model with no VSC that has if come. So that's the first time I'd heard that. Some of the other dealers said, I like that phrase. So I hadn't heard that.
Well, and that's that whole 15%.
And that's the phantom profit.
It's the phantom profit.
And it's also, is the customer going to have the income, and then will we collect? I mean, I could read if come a couple different ways, but it's like, if it's phantom profit, then it's kind of problematic for us potentially. In that it's potential income, but we're paying sales tax and income tax on that profit. So anyway, Connor Stoll responded last evening, and then I've had a follow-up question for him. He says, if you do opt to sell a VSC, we do not advise adding markup to the cost. So that's Connor.
Now, who's Connor?
Connor's with Preferred Dealer Solutions out of Michigan, I believe. And so he chimed in there, and so I said, I misread his answer first, so I edited that. And I said, can you expand on the part about why, if VSC, you do not advise the markup? I think that will answer core part of the question. And he said, 1, increase payment to customer when you do increase the cost of the VSC. Only so much room to add additional
We know
costs.
this is one of the pain points for all buy here, pay here dealers.
Right.
Is like every penny counts.
Right. And this is why this became such a, once we kind of drilled in on this, and I just sort of posed the question: if I'm a white hat dealer and my main motivation is to support the customer, and I choose a VSC over a warranty, then 1, I need to be able to be effective at selling it, and 2, what are the pain points for the customer, and am I hurting them and process hurting myself? Is really a broad way to think about this. And so now number 2 says, with dealerships running lean staff, does your staff have the time and capability to process pro rata refunds? And I think that's a subject we can tackle later, like the pro rata refunds. What he's really suggesting is that can be a heavy administrative thing.
Well, and that was part of the question I was asking this morning. Is it's like, with that money that we're marking it up, that's going directly in the dealership, are there costs associated with that markup that we're covering that you wouldn't have had you not done a vehicle service contract
at all?
That is the dealer incurring costs in their dealership? Like, their operating costs, are they incurring higher operating costs by having a vehicle service contract than if they didn't mark it up at all?
Okay, I'm not aware of it.
Okay.
So I think and a lot of the administrative costs are handled by the reinsurance company.
Okay, so most of what he's talking about is handled through a dealery, a Buckeye,
right?
I
think Connor's touching on something here that is relevant. It's not exactly, in the realm of what we're talking about here. It's like when you do have more markup and longer time to pay, then it does make sense to me that, you're more likely to experience a pro rata refund situation. And as some have said already, that's most likely going to happen in trades and repos. But I'm fairly sure, and we're not trying to go into compliance at all, but I'm fairly sure I read an article about an organization that was heavily penalized for not managing this part well. They charged for service contracts, but they didn't process the pro rata refund.
I have a recollection of that being a thing. And so there was a third part of that. Did you not want to cover that? There were 3 reasons.
I think the same thing. Is basically, have you set aside the markup funds to pay for the pro rata? So it's really about managing the money associated with that, and kind of the whole compliance piece. So Justin Browning is a dealer, I believe. I don't know Justin personally or Bill Bolton, who responded, but they basically said they do not mark up for basically the same reasons I was asking the question, and we'll give them a chance to expand on this, and maybe we can invite them to the podcast and take us through
absolutely.
This is part of what we had in mind to do, and I think that covers the parts, Michelle, that I really wanted to get to today. It's like we can continue this conversation, but I think for us it's about just being transparent, getting out there and being open about the thing, and figuring out, what is the. And it's like many of them said, it's dealer dependent. And it is true that that's going to vary a little bit. I'm just simply trying to get to the point of, is there something, is there some other benefit that I'm missing besides the additional profit in the company, additional profit? So I'm just trying to understand, is there something actually reinsurance specific?
Yeah.
That is,
I think that there's a lot of operational pieces that you could just kind of be batting around, like this idea of it shifting the advance rate, which we're not huge fans of higher advance rates, because that's where you see so many dealers fold.
And I have to ask this question, because this is part of what White Hat Way does, is have tough conversations and ask questions on behalf of dealers, right? Dealers are our primary listeners. Some of them are new. I have to ask the question, and I feel like most of us will know the answer. If we sell the product for more, does the reinsurance company make more? Reinsurance agent, reinsurance company. I'm talking about the actual agents and the commissions and the earnings of the reinsurance provider, not the dealership. So they make fees.
Yeah. So if you've got a company that's handling all your reinsurance and you're charging $2,000 or $1,900, where the cost is $1,000.
Yeah.
Is there more commission going
The
to?
answer may
I don't
be
know.
no, because the commission may only be associated with that remitted.
I'm sure that we'll get like boom, 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 boom,
probably
somewhere.
Like,
It's like no.
It's a fair question, and I think the answer, from everything I can tell, the cost based on what I've seen about ceding fees and where the administrative fees are, it's probably only related to the cost and the money that flows over to the reinsurance company. Okay, so in that case, that additional markup again stays in the dealership and probably doesn't affect commissions, but.
So I know that we've a lot of the CBFP stuff is the cars rule tabled, the Consumer Protection Bureau, and George is like, the answer is no. Right. The admin agency, et cetera, makes their fee just on the dealer cost, not on anything that's beyond. But so the next part of this is, and I do realize that it's there's a lot of dealers that are that we're not having to deal with this right now. We don't know for how long.
The CFPB, you mean?
The cars rule, all of those kind of things. But would it be considered if the if the cars rule were in full effect and you saw the same teeth in the CBFB as we have right now, would the markup of a VSC be considered predatory?
That's interpretation.
Okay. I'm just wondering if that would be.
It's hard for me to think of that as predatory, and here's why. Just being the voice, if you called me in as an expert witness on one of these kind of subjects, I would say, the customer should have been presented the product. It's like anything else. You walk into, a store and buy eggs, and they charge you $12 for eggs, and somebody else is charging $8. You knew the price. You knew you could shop elsewhere. Here's the price. You agreed to sign the thing, and you bought the thing. So I'm just saying, I don't think I see anything predatory there. Okay. There's a price that's, as long as the price is disclosed, customer understands what they're buying, and they agreed that it was a value for them. I don't see anything predatory.
Because I see some blurry lines around some of the cases, or the reasons why this came into effect. It's like, these anomalous charges, these, things that become profit centers for a dealer that are masked as something different.
Sure.
So
I get it. I think, generally speaking, customers don't fight us on APR.
Yeah.
Right. And they're just really not in a position to, unfortunately, they're not in a position to resist. Now they can go elsewhere. If they go to dealer one and they could go across the street and maybe get a different interest rate with somebody else, they can certainly do that. But as far as getting a dealer to negotiate, some of them offer tiered pricing, but not very many. So they're not going to probably fight us on interest rate. So I think my question would be, if I'm, and again, we're still questions, but I think it begs the question, if I had a profitability problem and I could move my APR up a little bit, I don't think the customer's going to fight me on that, right?
Yeah.
And I can make the case, and I really have to even explain it, but the APR is the APR, and I could probably increase my profitability that way. We don't advise in White Hat Way, we don't advise going to max rate. We think that's avoidable.
But we have it's like what's a reasonable rate?
Right. And so if I'm just looking purely at a profitability thing, again, I get it. If we do have a profitability problem, I'd rather see us look at expenses than adding more on the customer.
Yeah.
In this case, so if we can cut expenses
Yeah.
rather than adding to the price, then I'd rather see us be operationally efficient and go that route. But I think I don't expect anything here that we're talking about is really, and we're not attorneys, so there's nothing over here that we're offering legal advice or telling you what the regulators are going to say. We're just simply saying from a pure operational standpoint, I don't hear anything there. And so for me, it's more a question of portfolio success.
Yeah. George piped in and he says, predatory question comes in when something is sold as 100% penetration.
Yeah,
it's
good
like,
point.
Yeah.
And I think it's also, we understand that, that's a good point. When you sell it and basically all the customers are choosing it when it's an optional product, that starts to beg some questions about how it's being sold.
Karen piped in here, and I don't know if I wasn't listening at the right point, but he said something about payment and down payment. And I'm not sure where that.
I'm not sure what she means.
Yeah.
There
So
because I don't
Karen,
think the down payment from the customer is going to change.
Add
in
a
this
little bit of
case.
context.
I think we're negotiating with the customer, and dealers are always negotiating with the customer for as much down payment as they can get.
Yes.
So I haven't heard dealers going back to the customer and asking for additional down payment when the customer opts for a service contract.
Yeah.
But there's typically a payment bump, and we would be recommending a payment bump too. Why? Because we know these are high mile cars, and we know that success rate, decreases, over time, whatever. So I'm always of the opinion, if I'm financing a customer who has questionable credit, I would like to get the money in the bank as soon as possible without penalizing them on payment. I don't want to push their ratio to income too high, but I do want to get the payment in the bank and get and also, my motivation is to finance it shorter term as possible, and then treat them great and finance them another one in a couple of years, right?
Yeah.
So in that case, same thing here. If I did that strategy, if I financed it for 36 months and then traded them in 24, I never really banked that profit on the service contract probably anyway.
Yeah.
This is other math we could dig into.
And that's,
right?
and so it's that phantom profit thing where people is like, it's like, did you really,
But
did you really?
The scary
bring
part
that
of that is you can say, okay, so I've extended my term and I got $900 of paper profit in the deal. My lender advanced me 50% of that money. But if I never collected that money, I still owe the 50%.
Exactly.
Right.
Yeah.
And so this is,
it's like more that you have to pay back than
it's
you.
Pressure points. It's stress points on the business, and it kind of goes back to Chad Martin's thing about where are our stress points, especially around lending.
Yeah.
And so I didn't really expect to end up there today, but I think you start to see the how it becomes problematic in the whole thing. And so this is why we're just simply asking the question, asking dealers, and some dealers have already chimed in and said, we just do it at cost. And that cost should be enough to allow dealers to meet their claims and probably still have some money left over in the reinsurance company for all the reasons that dealers want to hold money in the reinsurance company, which we didn't need to go into that.
So, I'm obviously married by here. Married in. And so I haven't run a dealership, but just from all of the things we've been talking about, I don't see a solid reason why you would mark up. This is just me.
You don't hear.
I don't hear a solid reason why you would mark it up.
Okay.
Because it to me it's like it's either money that you will never collect, or it's an extra burden on the consumer.
Okay. I see one that you're not seeing.
Okay.
And that is, if I'm in a competitive market and even if I'm not putting prices online, when my customers come in, I if they're really price sensitive, which most markets are not price sensitive in buy here, pay here.
Yeah.
So I think we're talking about the exception rather than the rule. Okay. So in most cases that wouldn't be
like just a regular independent dealer. They also have reinsurance, and so it does make a difference.
But in our case, we're toting the note on these service contracts ourselves. So I'm talking today. It's been about reinsured, sort of self-insured. Reinsurance product as a vehicle service contract. So in that case, I say that there would be benefit if I'm in a market where they're super competitive on price and I need to compete on both payment and down payment or whatever else. I need to be able to be in here to be competitive. Then I would enjoy the markup, of a back end product, as long as it doesn't defeat my term strategy and everything else. Then if I could make up profit over there, with some customers or more than half the customers, then it helps my profitability in that regard. But otherwise, that's why I put that question aside. We recognize that that's a strategy and could be beneficial to those,
Yeah.
but most markets aren't competitive in that way.
Yeah. And so, for me, the white hat way element thread into this is, we really do believe that doing good for the customer and making it easier for the customer is actually good for the dealer, because the easier you can make it for the customer to be successful in their loan, that just means more money in the bank, not phantom profit, real money and, real cash. And so and I don't know if there's something I am completely missing, but when from my perspective, you look at this 10,000 foot view, it doesn't make any sense.
Okay.
It just, I don't.
Well, I wasn't trying to sell you today.
I know, but I mean, I'm just like, it's unless I'm just looking at it as just solely a profit center.
Yeah.
But then again, that's probably profit you will not see if 85% of our contracts don't meet the end of the contract. Sure. And usually if you're adding, lengthening the length of the contract, those 2 or 3, 4 months of what that, you're tacking that on the end, you're not going to see anyway.
Right.
So it's like the idea that it's a profit center is that really true? Or is it just look good on paper?
Yeah, it's a good question.
Yeah,
I mean, it's a fair question. I think it's a part of what we can dig into on behalf of dealers.
Yeah, and just real quick, Karen was like, her question about payment and down payment was in negotiations, not APR sensitive, like you said. Even a small PIK pay can reduce the payment enough to make a customer more comfortable with the payment.
Yeah.
And one last comment from George. Since warranties are not cancelable, refundable, the dealer cost set up for the reinsurance would be less. Okay. In your example, the $100 or $1,000 VSC cost would equate to about $700 in warranty cost.
And that's valid. It just wasn't our subject. It wasn't our focus today.
So and Jim was like, let's not bring in warranties. And I'm just, and so, cause I kept like peppering him as like, I don't understand why that wouldn't be the thing. And he's like, this is not the conversation, Michelle.
This business can be a difficult enough game of whack-a-mole without, let's just keep it narrow. Let's keep it on this one subject.
Yeah. So we're just talking about that.
I want to circle back to one thing, which will make me a little bit unpopular, but I want to make sure and clarify. Earlier I said that in most markets, prices are not competitive. We're not price sensitive. We don't have price sensitive consumers. Mm-hmm. Some will say that's not necessarily true. And I would just ask the question, is the customer making it about price, or is that us? In most markets.
Unless it's not necessarily about price, but about payment.
And financing.
And so it's like
in terms of down payment.
Yeah.
Is the customer really saying, and it happens. The customer says that price is too high. But I also know what happens is that we as dealers and members of the team, sales team, whatever, we tend to be the ones who make it about price. In most markets, most buy here, pay your customers. And I'm sorry, the fundamentalist in me says the customer is still interested in how much payment and how much down payment.
Yeah.
Right? So maybe kind of where Karen was going. We just, if I could put a customer in a nice car and make it fit on down payment, they're probably not going to fight me on price and APR.
I agreed. Right. All right, everybody. Thank you so much for joining us today. We really appreciate you making us part of your day. Again, go to YouTube, which is Jim and Michelle Rhoads with Octane Group. Like and subscribe while you're there if you want to take a look at the actual chart that we were talking about and all the other ones that we talk about too. Enjoy. Everyone's knee deep in tax time. Those checks are coming in, and so people are seeing an it's this season. I hope you guys have a great rest of your week. We will see you on Friday. I don't think we have a topic yet. Got some stuff that's in there. Yeah. But thanks again so much for joining us, and we will see you guys on Friday.